Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about Risk Management Module B of Bank Financial Management CAIIB course. Now let's talk about Basel 1 Accord. Now this will be a summary video which will cover the entire module in a summary format. You can get a copy of this PPT in PDF format in the description box. I have provided the link. You can click and you can download the PDF format of this PPT for quick revision. Now, for the first time, the framework was provided for capital adequacy. It defined components of capital, allotted risk weights to assets, pronounced the minimum ratio of capital to sum total of risk weighted assets. It initially covered only credit risk and subsequently it covered market risk. Now, Basel II for banks having global presence and foreign banks in India from March 2008, for the other banks from March 2009. Now, Basel II had the revised framework covering operational risk. It was based on three pillars: minimum capital requirement, supervisory review process, and market discipline. Now, as per the minimum capital requirement, the credit risk can be measured through three approaches: standardized approach, internal rating based approach, and internal rating based approach advanced. Now, market risk can be measured through standardized approach, through maturity and through duration, and internal models method. Operational risk can be measured through basic indicator approach, standardized approach, and advanced measurement approach. Supervisory review process to ensure robust internal processes for risk management for adequacy of capital, evaluation of risk assessment, and prescribe differential capital wherever necessary. Now, market discipline, it's the disclosure norms about the risk management practices and allocation of regulatory capital. To enhance disclosures, core and discretionary, timely disclosures. Regulatory capital can be divided in three parts: Tier 1, Tier 2, and Tier 3. Tier 1 is the core capital, which includes capital, free reserves, unallocated surpluses, less specified deductions. Tier 2, which is also called supplementary capital, it is or it has subordinated debt of more than 5 years maturity, loan loss reserves, revaluation reserve, investment fluctuation reserves, limited life preferential shares. Tier 2 capital is restricted to 100% of Tier 1 capital and long-term debt not exceeding 50% of Tier 1 capital. Now, Tier 3 capital is short-term subordinated debt for the sole purpose of meeting a proportion of the capital requirement for market risk. Short-term bond must have an original maturity of at least 2 years. Tier 3 capital will be limited to 250% of bank's Tier 1 capital required to support market risk of the bank. Capital adequacy: any capital requirement arising in respect of credit risk or counterparty risk must be met by Tier 1 and Tier 2 capital. Minimum of 28.5 of the market risk needs to be supported by Tier 1 capital. Now, what is credit risk and capital adequacy ratio? There are two methodologies for measuring it: external agencies and internal assessment. For credit rating of sovereign, the country's course of export credit agency may be recognized. Now, credit rating of commercial banks: all banks in a given country will be assigned a risk weight, one below the risk weight assigned to that of the sovereign. However, for claims on banks in countries with sovereign rating from BB plus to B minus, the banks in rated countries where uh, risk weight will be capped at 100%. Now, bases the risk, the credit rating of commercial bank bases the risk weighting on the external credit assessment of the bank itself. Unrated banks will have a risk weight of 50%. Risk weight of sovereign banks, various risk weights, you can go through it. In case of past due housing loans, 100%. Risk weights when the claim amount is guaranteed by another party or agency with a better rating, the risk weight would reduce accordingly. Simplified standard approach for sovereign exposure rating 1 being used by export credit agency, risk weight of the corporate is flat 100% since ratings are not used. Reduce risk weight of 75% and 30% of retail and housing portfolio. The IRB approach, internal rating based approach, capital charge computation is dependent upon the following parameters: probability of default, loss given at default, exposure at default, effective maturity. Computes capital requirement of each exposure directly, categorization of assets as corporate, sovereign, banks, retail, and equity. Banks provide their own estimates of, okay. Market risk is defined as the risk of losses in on the balance sheet and off balance sheet positions arising from movement in the market prices. Now, the market risk position which require capital changes are interest rate related instruments in trading book, equities in trading book, foreign exchange open position including position in precious metal throughout the bank. A trading book consists of financial instruments and commodities held either with trading intent or in order to hedge other elements in trading book. The positions need to be valued frequently and accurately. In Indian scenario, the trading books comprises of securities under held for TRDG, securities under available for sale, open forex position, open gold position, trading position, derivatives and hedging. So capital charge for interest related instruments, capital charge for market risk, capital charge for equities in trading book. Operational risk is defined as the risk of loss resulting from inadequate or failed internal processes, people and system, or from external events. It includes legal risk but excludes strategies and reputational risk. Now, capital charge basic indicator approach for operational risk is calculated using basic indicator approach, standardized approach, advanced measurement approach. So as per the basic indicator approach, equal to the average over the previous 3 years of a fixed percentage, it is denoted by alpha of positive annual gross income. The amount should be gross of any provision, should be gross of operating expenses, should exclude realized profit or losses from the sale of investment, should exclude extraordinary or irregular items and income derived. Advances of measurement approach, qualitative standards, various other aspects which we need to take into consideration. External credit rating institute, supervisory review that the banks have adequate capital to support all risk in their business, to encourage banks to develop and use better risk management techniques in monitoring and mitigating their risk. Supervisors need to concentrate risk considered under Pillar 1 but not fully captured. Okay, these are some of the principles, precautions which you can take. The market discipline, it is in support of Pillar 1 and 2, disclosure for all allowing public to ask key information, profit planning, factors affecting profitability. Profit planning involves balance sheet management covering credit, investment, and non-fund income. Income comes from interest on advances, fee-based income, and treasury operations. These are some of the examples which you can go through. Fee-based income, treasury income, expenditure side. Okay, so if you like this video, I'm sure you would have learned a lot of valuable uh, lessons from this video. It's a summary format which you can download from the link in the description box below. It will be very useful for revision and summary. Well, thank you.